Usually when we talk about like a medical diagnosis, there's this expectation of absolute clinical precision.
Oh, for sure. It feels like engineering.
Right. Like you break your arm, they put you in an x-ray machine, the scan pops up, and there's that unmistakable jagged white line across the bone.
And the doctor just points to it and says, there it is, that's the break.
Exactly. It's incredibly binary, broken or not broken. It's clean, it's visible, and honestly, it's comforting. We like things to be categorized neatly.
We want a clear picture of exactly what we're dealing with, but then you step into the world of investment banking.
Yeah, and suddenly you realize that X-ray machine is completely shattered.
Totally shattered.
We're looking at a financial landscape that is just incredibly murky. You're looking at a multi-billion-dollar company trying to figure out its exact worth.
Its exact health, its vulnerabilities.
Right, and there isn't just one simple X-ray you can take to get the answer. So today, we're speaking directly to you.
Whether you're currently drowning in flashcards, preparing for the Series 79 exam, or you're actually navigating the very real, very high-stakes M&A world.
Or maybe you're just insanely curious about how these massive market-moving deals actually get done behind closed doors. We're going to map out that murky landscape.
I mean, that X-ray analogy really captures the inherent anxiety of the job, because there is no single machine that spits out a valuation.
Right.
Bankers have to build their own machine out of hundreds of different data points. It's not magic, even though the media often portrays high finance that way.
It's just sheer rigorous mechanics.
Exactly. And today we're working from a very specific foundational source, an excerpt detailing the framework for investment banking analysis and communication.
And this document, it serves as the absolute blueprint for how this industry functions at a foundational level.
It really does.
So our mission today for this deep dive is to decode that exact blueprint.
Yeah.
We want to understand how investment bankers pull apart a company's financials to analyze them.
How they engineer a valuation that buyers will actually believe.
And how they execute the final deal in the open market. And crucially, because this is where careers are made or ruined, how they navigate an absolute minefield of strict communication protocols.
Oh, the communication protocols are everything.
Because looking at our source text today, it really boils down to two fundamental, almost opposing forces.
Finding the absolute verifiable truth in a sea of manipulated data.
And knowing exactly who you are legally allowed to talk to once you find that truth.
Right. It's this delicate balance of data gathering and boundary management.
Because you can build the most elegant, mathematically flawless financial model in the history of Wall Street.
But if you cross a communication boundary...
Yeah, if you leak material information to the wrong internal department.
You don't have a closed deal. You have a federal subpoena and the end of your career.
Wow. Yeah, and we aren't just going to recite theoretical math today, are we?
No, we're going to walk through the actual anatomy of a deal, from the very first database search to the final pricing call.
So before a banker can even dream of slapping a valuation on a company, they need the raw materials.
The data gathering phase.
Right. Our source lays out this incredibly rigorous, almost obsessive data gathering phase. It mandates the collection of financial data, performance metrics, issuance history.
And transaction data.
Yeah, and it lists a very specific ecosystem of where this data is supposed to come from. Commercial and proprietary market databases, regulatory sources.
The internet sites of private and public companies.
And general media. Now, looking at that list, it honestly sounds like they're just Googling everything and throwing it into a spreadsheet.
It does sound like that, yeah.
But there's a strict hierarchy to this information, isn't there?
A very strict hierarchy. And understanding it is crucial, especially if you're analyzing this for an exam like the Series 79.
Right.
Let's look at the redundancy the source requires, because at first glance it seems inefficient. The text explicitly tells bankers to use commercial and proprietary market databases.
We're talking about the ubiquitous, highly expensive terminal software, right? Capital IQ, FactSet, Bloomberg.
Exactly. These tools cost tens of thousands of dollars per seat.
Right. And if I'm a managing director paying that much money for a proprietary database, my immediate thought is, shouldn't that be enough?
You'd think so.
I mean, if the terminal says a company's revenue is $500 million, why do I need to go anywhere else?
Because you're paying for speed and aggregation, not necessarily unvarnished reality.
Okay, unpack that for me.
Well, these proprietary databases are incredible tools. They scrape thousands of financial documents and standardize the data so you can instantly compare company A to company B.
Which saves weeks of work.
Sure. But the act of standardizing data inherently strips away the nuance.
How so?
Let's say you're looking at an aerospace company on a terminal. The terminal might categorize a one-time massive legal settlement regarding a faulty engine as a standard operating expense.
Oh, just to make it fit into their standardized spreadsheet format.
Exactly. So if you just pull that terminal data and drop it into your valuation model, your model is going to assume the company has incredibly high ongoing operating costs.
Wow. So your valuation will be instantly fundamentally flawed.
It smooths out the bumps, yeah.
But in an M&A deal, the bumps are what kill you.
Exactly. That's why the framework demands that bankers cross-reference this aggregated database information with other sources.
You check the public media to understand the actual sentiment and recent events.
Right, like discovering that operating expense was actually a highly publicized lawsuit.
And you check the private company sites to see how the company currently positions its product lines versus what the historical data says.
You're constantly triangulating the truth, using the speed of the databases, but verifying it against the messy reality of the real world.
I love that phrase, triangulating the truth. But if we're talking about finding the absolute truth, we have to talk about the gold standard.
The 1934 Act filings.
Yes. The source explicitly highlights information found in schedules, reports, statements, and forms filed pursuant to the Securities Exchange Act of 1934.
A critical area for the Series 79, by the way.
Absolutely. And the way I've always thought about this hierarchy is like a relationship.
Okay, I like where this is going.
Like a company's own website, their press releases, the CEO's interview on financial television.
That's the dating profile.
Yes. It's the best lighting, the most flattering angles. It's all, we're experiencing robust synergies, and our total addressable market is infinite.
Always infinite.
Always. But the 1934 Act filings, that is the rigorous private investigator background check.
That is a phenomenal way to contextualize it. The 1934 Act is the bedrock of secondary market trading and ongoing public company disclosure in the U.S.
For anyone preparing for the Series 79, you really need to understand the gravity of these documents.
It's a cornerstone of the curriculum. The Act mandates continuous reporting. We're talking about the 10K, which is the comprehensive annual report.
And the 10Q, the quarterly report.
Right. And the 8K, which is the current report, used to announce major events that shareholders need to know about immediately.
Let's actually pause and dig into those because regulatory filing sounds so dry, but the contents of these documents are wild.
They really are.
When we say it's the unvarnished truth, what actually goes into a 10K that a company wouldn't put in a press release?
The beauty of the 10K is the mandated risk factors section.
Oh, I love reading those.
They're eye-opening. By law, management has to disclose every realistic existential threat to their business.
So a tech company might put out a press release talking about their revolutionary new AI algorithm.
But in their 10K, under the risk factors, they are legally required to admit that their entire algorithm relies on a single patent that expires in 18 months.
Or that they're currently under investigation by the FTC for data privacy violations.
Exactly. Furthermore, the financial statements in a 10K are audited by an independent accounting firm.
So it's not just the CEO's rosy math. Somebody outside the beginning had to sign their name and risk their own firm's reputation to say, yes, these numbers are real.
Precisely. And let's look at the 8K. The 8K is the real-time heartbeat of corporate drama.
If the CEO suddenly resigns in the middle of the night.
Or if the company defaults on a major loan. Or if they acquire another company.
They have 4 business days to file an 8K.
Exactly. So when an investment banker is trying to gather reliable financial data, they aren't just looking at the math, they're reading the narrative hidden in these legal disclosures.
Because later on in this process, we're going to be building incredibly complex financial models and drafting marketing materials to sell this company.
Right.
And if your foundational numbers, like your starting point, is based on an optimistic press release rather than the audited 10K,
your entire valuation collapses. It's like building a skyscraper on a swamp.
it's a fatal flaw.
It really is. In investment banking, relying on unverified data isn't just an oops moment, it's professional negligence.
The 1934 Act filings are the heavy anchor that keeps the entire analytical engine grounded in reality.
The framework dictates this because without that baseline of absolute, legally binding truth, everything else you do is just fiction.
Okay, so we know where to look. We're scrubbing the proprietary databases for speed, but we're anchoring our reality in the 1934 Act filings.
Right.
But the source also dictates how we have to look at this data. It specifically mandates analyzing trends in the market and specific industry sectors before analyzing individual companies.
Yes, macro before micro.
And I want to challenge this methodology a bit. If I'm an investment banker and my client has hired me to sell one specific mid-sized software company,
Okay.
why do I need to spend weeks zooming out to analyze the macroeconomic weather of the entire global software sector?
Ah.
Shouldn't I just put my specific target company under a microscope from day one?
It's a totally fair question. But if we don't look at the macro weather first, we have absolutely no way to judge the micro
Well,
performance.
even with all their internal data.
You cannot evaluate a company's performance in a vacuum. Let's build a scenario.
Okay, let's do it.
Imagine you're that banker and you're analyzing a semiconductor manufacturing company. You look at their internal numbers and you see that their revenue grew by 20% over the last 12 months.
Which sounds great.
Right. If you only look at the target company, your immediate conclusion is highly positive. 20% top-line growth is fantastic. You think management is executing perfectly.
Any business owner would be thrilled with 20% growth. It looks like a massive win.
But now, let's follow the framework. Let's zoom out and analyze the trends in the specific industry sector.
Okay.
You pull the data on the broader semiconductor market, and you discover that over the last 12 months, there was a massive global chip shortage, coupled with an explosion in demand for electric vehicles.
Ah, I see where this is going.
Because of these macro trends, the entire semiconductor sector grew its revenue by 60%.
Oh, wow. So suddenly that 20% growth doesn't look like a win at all.
Not at all.
It means they're massively underperforming their peers.
Exactly. In reality, they are bleeding market share. While all their competitors were capturing the 60% windfall of the sector boom, your target company only managed to capture 20%.
A rising tide lifts all boats, so you need to know if they're rowing or just floating.
The framework requires you to analyze the sector first so you can determine if a company is actually succeeding through its own operational merits.
Its own competitive moats.
Right. Or if it's merely floating passively on a massive sector-wide trend.
And I imagine the inverse is true as well. Like, if you're analyzing a retail chain and their revenue is completely flat year over year, 0% growth.
In a vacuum, that looks stagnant.
Right. But if you analyze the retail sector and see that brick-and-mortar retail overall crashed by 15% due to a recession,
Then your target company's 0% growth is actually a spectacular victory.
they're a fortress.
Exactly. That is precisely why the framework demands macro before micro. Analyzing the broader environment establishes the baseline.
Without the baseline, you cannot accurately judge the individual company.
And if you misjudge their performance, your subsequent valuation will be entirely wrong.
That makes total sense. Context is everything.
Always.
So we've gathered our mountains of data, we've scrubbed the databases, we've done our background checks in the 1934 Act filings to ensure we aren't being lied to.
Yep.
And we've analyzed the industry weather so we know exactly how our target company is performing relative to the world around them.
Now, we have to transition from just hoarding data to actually weaponizing it.
We need to turn information into a price tag.
This brings us to the valuation engine.
Right. Our source framework highlights the necessity of analyzing the capital structure and valuation metrics of comparable companies.
Let's take this piece by piece, because this is where the heavy lifting happens.
What exactly are we looking for when we analyze a peer company's capital structure?
Capital structure is, simply put, the permanent blueprint of how a company funds its operations and growth.
It's the specific mix of debt and equity.
Yeah. Exactly. Debt includes things like bank loans, corporate bonds, revolving credit facilities, and equity is the common and preferred stock held by owners and investors.
And why does an investment banker care so much about how the peer companies fund themselves? If I'm selling company A, why do I care how much debt company B has?
Because analyzing the peer's capital structure tells you what the market considers normal, safe, and optimal for that specific industry.
Oh, because different industries can handle completely different debt limits.
Exactly. Think about a software as a service company with highly predictable, recurring monthly revenue. They can safely carry a significant amount of debt because their cash flow is so stable they can easily make the interest payments.
But a biotech startup that burns cash and won't have a product for 10 years.
They should have almost zero debt. They need to be funded entirely by equity because they have no cash flow to service a loan.
Okay, so if I look at my target company's capital structure, and they have zero debt, but I look at the comparable companies in their sector, and they all operate with roughly 40% debt. What does that tell me?
It tells you that your target company might be drastically underleveraged, which means they are likely operating inefficiently.
Wait, isn't having zero debt a good thing? It sounds incredibly safe.
It is safe, but in corporate finance, excessive safety often destroys potential value.
How so?
Debt, when used correctly, is a powerful tool because interest payments on debt are tax deductible. Adding a prudent amount of debt lowers a company's overall tax burden.
Oh, and it decreases their overall cost of capital.
Furthermore, if you fund a new factory with a loan instead of issuing new shares of stock, you aren't diluting the existing owner's ownership percentage.
So if your target company has zero debt, while the industry standard is 40%, an investment banker looks at that and sees a massive opportunity.
A private equity buyer could swoop in, acquire the company, immediately layer on that standard 40% debt,
Use the borrowed money to pay themselves a massive dividend.
and optimize the company's tax shield.
So analyzing the peer's capital structure helps you identify the hidden, untapped potential in the company you're evaluating.
Or on the flip side, if your target has 80% debt and the peers only have 20%, you know your target is carrying a terrifying amount of risk.
Exactly. It contextualizes financial risk and reveals structural optimization opportunities.
Once you understand the structure, you can move on to the actual valuation metrics.
Right. The text mandates analyzing these metrics across comparable companies to perform a relative valuation analysis.
Let's define the metrics first.
Yeah, when we talk about valuation metrics, the one everyone hears on the financial news is the PE ratio, the price to earnings ratio.
Right.
But in investment banking, the holy grail metric that gets thrown around constantly is EV to EBITDA, enterprise value to EBITDA.
Can we break this down? Because it sounds like alphabet soup.
Let's start with the denominator, EBITDA, earnings before interest, taxes, depreciation, and amortization.
Why do bankers love this specific metric so much? Why don't they just look at net income?
That is perhaps the most important technical question we can address today.
To understand why bankers rely on EBITDA, we have to look at the flaw of using net income for a relative valuation.
Net income is the literal bottom line on an income statement.
It's the profit left over after every single expense has been paid. But remember, our goal here, we want to compare the core operational performance of two different companies on an apples-to-apples basis.
So let's build an analogy.
Let's do it.
Let's say you and I own competing manufacturing plants. We make the exact same product, we sell it for the exact same price, we have the exact same number of employees.
And we have the exact same operational efficiency.
At a pure business level, our companies are identical twins.
Perfect. But let's say you inherited your factory from your grandfather, so you have zero debt.
And I operate in a state with zero corporate income tax.
I, on the other hand, had to take out a massive $10 million bank loan to build my factory, so I'm paying huge interest expenses every month.
And you operate in a state with a 10% corporate tax rate.
Okay, so if we look at our net income, the bottom line,
My net income is going to be wildly higher than yours. Yours is getting crushed by the interest payments and the taxes.
exactly. If a buyer only looked at net income, they would conclude that your company is a phenomenally better business than mine.
But that's a lie. Operationally, we are identical.
The only difference is our capital structure, my debt, and our tax jurisdiction.
And this is where EBITDA comes to the rescue.
By taking our earnings and adding back the interest, the taxes, the depreciation, and the amortization,
We strip away all the financial engineering, the geographic tax differences, and the accounting artifacts.
we strip it down to the naked operational cash-generating power of the actual business itself.
Yes, EBITDA gives us that pure operational number.
Once we have that, we look at the numerator, enterprise value, or EV.
Enterprise value is the total theoretical takeover price of the entire company, right?
Yes, it's the market cap of the stock plus all the outstanding debt, minus the cash on hand.
So when we look at the EV to EBITDA multiple of comparable companies, we are asking a very specific question.
How many times a company's pure operational cash flow is the market willing to pay to own the entire enterprise?
And this brings us right back to the text's requirement for relative valuation analysis.
The source defines this as checking the company's relative position when comparing its valuation with other companies in the same industry.
I always conceptualize this like real estate. If you're trying to price your house, you don't just stare at the bricks and the square footage in isolation and try to guess a number.
No, you look at what the identical house across the street just sold for.
Exactly. If the house across the street sold for $500,000 and it has an EV to EBITDA multiple of 10x.
Then you assume the baseline multiple for your house is also 10x.
But let's say your house has a newly renovated kitchen and a swimming pool.
In corporate terms, that newly renovated kitchen might mean your target company has profit margins that are 5% higher than the peer average.
Or a customer churn rate that is significantly lower.
Because your target company is operationally superior to the average comparable company, you argue that it deserves to trade at a premium to the peer multiple.
So instead of a 10x multiple, you argue it deserves an 11x or 12x multiple.
And this is where the math turns into the narrative. The relative positioning isn't just an academic exercise to find a static price tag.
It's a dynamic, persuasive tool.
If you're the investment banker hired to sell this company, discovering that positioning becomes the absolute core of your marketing pitch.
If your analysis shows the company is currently trading at a discount to its peers, say an 8x multiple when the industry average is 10x,
Despite having solid fundamentals.
well, there is your pitch to a private equity buyer. You are offering them an undervalued asset.
You tell them, buy this at an 8x multiple, fix their marketing department, and flip it in 3 years at the industry standard 10x multiple.
But if it deserves to trade at a premium, your pitch shifts entirely to highlighting its market dominance and its unassailable competitive moat.
That is exactly how the valuation engine works in practice.
But the source framework does not stop at analyzing comparable public companies.
No, it adds another layer of rigorous reality testing.
It requires bankers to track recent securities offerings and M&A deals, what it officially refers to as precedent transactions.
Executed by both the banker's own firm and by rival competitors.
This is a major area of focus for the Series 79 exam.
Huge. Let's really pull this apart. We just spent all this time finding our relative valuation using public peers.
Why do we have to go back and analyze past M&A deals? What does a precedent transaction tell us that the public stock market doesn't?
It tells us the cost of control.
Okay, unpack that.
A comparable company analysis based on public stock prices tells you what a single minority share of a company is worth to a passive investor on a random Tuesday.
But a precedent transaction is the ultimate reality check.
It tells you what an actual highly motivated acquirer was willing to pay to take absolute control of an entire company.
Right, because buying 10 shares of a company on your brokerage app so you can collect a tiny dividend is fundamentally different from buying the entire company.
Firing the board of directors.
Selling off the European division and absorbing their patented technology into your own pipeline.
Exactly. When you buy control, you unlock immense strategic value that a passive shareholder never sees.
Because of that strategic value, an acquirer almost always has to pay a massive premium over the current public stock price to convince the current shareholders to sell.
This difference is called the control premium.
Precedent transactions show you exactly what that control premium looks like in the current market environment for your specific industry.
It is not theoretical math derived from a terminal. It is historical fact. It shows you the actual checks that were written, signed, and cleared.
So if public comparable companies are trading at a 10x EBITDA multiple, but you look at the last 3 precedent transactions in the sector,
And see that acquirers paid a 13x, 14x, and 13.5x multiple.
you know that the control premium is roughly an additional 3 turns of EBITDA.
Correct. But the framework adds a very specific nuance here.
It dictates that you must track deals executed by your competitors as well.
You aren't just looking at the final price they got. You are engaged in vital competitive intelligence.
You're analyzing how the rival banks structured those deals.
Deal structure is fascinating because it's rarely just a simple briefcase full of cash.
Let's talk about how deals actually clear the market. Let's say a rival bank just successfully sold a competitor in your space, and you're analyzing that precedent transaction.
What kind of structural details are you hunting for?
You tell me. What are we looking for?
You are looking for the mechanisms they use to bridge valuation gaps.
Like an earnout structure.
A classic example. Let's say you have a tech founder who absolutely insists their company is worth $1 billion based on their projected growth.
But the acquiring company looks at the risks and says, we're only willing to guarantee $800 million today.
That is a massive $200 million chasm. In the past, that gap might have killed the deal.
So how does the earnout fix it?
The rival bank structures an earnout. They say to the founder, the buyer will pay you $800 million in cash today.
Okay.
But if your company actually hits the aggressive revenue targets you are projecting over the next 24 months, the buyer will pay you the remaining $200 million.
It bridges the gap by shifting the risk of future performance back onto the seller.
That is brilliant. It forces the founder to put their money where their mouth is regarding their projection.
Exactly. And if you're an investment banker tracking competitor deals and you notice that the last four successful precedent transactions in your sector all heavily utilized earnout structures,
That is critical market intelligence.
it tells you that buyers in this specific sector are currently highly risk-averse and unwilling to pay full price upfront based on projections alone.
It prevents you from taking your own deal to market with a naive, all-cash upfront demand that buyers will immediately reject.
Analyzing competitor precedent transactions teaches you the current language of the market.
Okay, let's take a deep breath and take stock of where we are. We've scraped the proprietary databases.
We've done the rigorous background checks in the 1934 Act filings.
We understand the macroeconomic industry weather.
We've analyzed the capital structures of our peers.
We've calculated our EV to EBITDA multiples to find our relative valuation.
And we've analyzed the precedent transactions to calculate the control premium and understand the current market's preferred deal structures.
The math is done.
We have a beautifully constructed valuation model. We know exactly what this company is worth and exactly how to structure the sale.
We are ready to build the final pitch and take this deal to the buyers, right?
Right. Wait. If you do that right now, you're going to trigger a massive legal crisis for your firm.
And here we hit the wall.
The text introduces a massive structural hurdle. You have all this verified data, you have this incredibly precise valuation, but you cannot just talk to anyone about it.
The source framework explicitly dictates permissible communications with clients and internal departments.
And heavily emphasizes the necessity of coordinating with legal and compliance departments.
I want to really dig into the friction here. Why all the secrecy? Why do we suddenly need a phalanx of lawyers? We're just trying to execute a math-based transaction.
Because the map you just calculated is highly sensitive, radioactive material.
We have to address the stark underlying reality of these rules. In the industry, this concept is universally referred to as the Chinese wall, or the information barrier.
Though our specific text focuses purely on the mechanical execution of permissible communications.
Right. As an investment banker working on an M&A deal or pricing a new securities offering, you are in possession of MNPI, material non-public information.
Things the general public and the broader stock market does not know yet.
Precisely. Let's go back to our earlier example. You have determined that Company A is going to acquire Company B.
And because of the control premium we discussed, they are going to pay 30% premium over Company B's current public stock price.
If the public knew that fact today, Company B's stock would instantly shoot up 30% to match the acquisition price.
It's guaranteed profit if you know the secret.
Yes, and trading on that secret is illegal insider trading.
Because you hold this market-moving data, the legal and compliance departments must act as absolute, unyielding gatekeepers.
They are there to prevent insider trading risks and ensure strict regulatory adherence.
You, as the M&A banker, cannot simply walk down the hall, grab a coffee, and tell a trader at your own firm about the deal you're working on.
Because that trader could immediately start buying options on Company B for the firm's proprietary trading desk.
Completely manipulating the market and breaking federal securities law.
So the entire concept of permissible communications is fundamentally about legally protecting the investment bank from itself.
It's about compartmentalization.
Exactly. It limits who is over the wall on a specific transaction. Everyone who knows about the deal is tracked.
Every time the deal progresses and you need to bring someone new into the conversation,
Say you need an equity syndicate manager to weigh in.
legal and compliance must explicitly clear that individual to ensure the flow of information doesn't violate internal policies or SEC regulations.
This has to create an incredible amount of internal friction. Investment bankers are deal makers. They are aggressive. They want to move fast.
They want to leverage every resource the firm has to get the deal closed.
And yet compliance is constantly standing there saying, no, you cannot talk to that person. No, you cannot share that spreadsheet.
Friction is legendary, but it is necessary. Compliance is not the enemy of the banker.
Compliance is the shield that keeps the firm's charter intact.
However, the text does specify some crucial groups of people you are permitted, and in fact mandated, to communicate with during this walled-off period.
For instance, it specifically mandates communicating with clients to gather and verify information for financial modeling and financial statements.
Let's explore that client interface, because this seems to be where the historical data meets the future.
Think back to our first step, the databases and the 1934 Act filings.
Those documents are phenomenal, but they are inherently backward-looking. A 10K tells you exactly what happened over the last 12 months.
It is the historical baseline. But an M&A deal, or a valuation, isn't based on the past.
The buyer is planning for the future.
The banker has to build a discounted cash flow model, a DCF, that projects the company's revenue and expenses 5 years into the future.
And you absolutely cannot get the future from a database.
No, you cannot. A terminal cannot tell you the CEO's strategic vision.
This is why the framework mandates this specific client communication.
The banker must verify forward-looking assumptions directly with the management team.
You sit down with the CFO and you ask the hard questions.
I see your historical growth is 10%. But for next year, are you planning to open 10 new retail locations or 50?
Are you anticipating a massive supply chain disruption in your Asian manufacturing hubs?
Are you planning to increase your marketing spend by 20% to launch a new product line?
And the banker takes those client-verified answers and hard codes them into the financial model.
Exactly. The banker needs the client to verify these assumptions, so the financial models are completely accurate reflections of the company's intended trajectory.
It is a vital two-way street of information.
The banker brings the historical industry-wide context.
And the client brings the forward-looking, company-specific roadmap.
And all of this communication is strictly governed by those permissible communication rules, ensuring that none of the client's forward-looking secrets leak out to the broader market before the deal is officially announced.
All right, so we are locked safely behind the Chinese wall.
We have the historical data, we have the client's verified forward-looking projections.
We have built the valuation model, and legal and compliance have given us their blessing to proceed.
Now we face a new challenge.
A spreadsheet, no matter how perfectly mathematically constructed, is not a story. It is not a sales pitch.
To actually convince a buyer to write a multi-billion-dollar check, we need to craft a compelling narrative.
And according to our framework, the banker does not do this alone.
We have to leverage the firm's internal brain trust.
This brings us to the internal strategy phase.
The text mandates communication with the firm's internal research department to obtain perspectives on the market and particular industry sectors.
And here, I have to push back again because this feels redundant.
How so?
Wait a minute. Didn't the banker already analyze the market trends and the sector weather way back in step 1? Why are we going down the hall to the research department to ask them about the industry sector again?
It's a great catch, but it highlights a crucial difference in the type of information being gathered.
Okay, what's the difference?
It raises the fundamental difference between historical data and real-time market sentiment. You are right. The banker meticulously looked at the quantitative data in step 1.
They know exactly what the sector did over the last 5 years.
But the research department, specifically the equity research analysts who cover these sectors, they live and breathe the daily qualitative narrative of the market.
Their entire job is talking to buy-side investors, portfolio managers, and hedge funds all day, every day.
So while the banker is looking at spreadsheets, the research analyst is taking the pulse of the buyers.
They know what the investors are feeling right now this morning.
Exactly. The banker possesses the quantitative analysis. The research department provides the crucial qualitative overlay.
Let's return to our software company example.
The banker might look at the data and see that software sector revenues are up 10%, margins are stable, and the historical EV to EBITDA multiples are strong.
Based on the math, it looks like a perfect time to sell the company at a premium.
But when they cross the hall to talk to the equity research analyst, the analyst might say, yes, the historical data is great, but every single institutional investor I spoke to on the phone this week is absolutely terrified of an impending software bubble.
They think AI is going to destroy the traditional SaaS business model, and they are aggressively refusing to pay historical multiples for any software asset right now.
Oh, wow. So the historical data is screaming sell high, but the real-time sentiment is whispering no one is buying.
Right. And you desperately need to know that before you finalize your valuation and take the deal to market.
The research department provides that real-time, forward-looking market perspective that the static databases simply cannot capture.
They keep the banker's models tethered to the reality of current investor psychology.
That is fascinating. It's the difference between reading the box score of a baseball game the next morning versus actually sitting in the stadium and feeling the momentum shift in the bottom of the ninth inning.
Okay, so alongside the research department, the text also mandates communication with industry specialists within the firm.
And it splits this interaction into two distinct goals.
Goal 1, obtaining information regarding business opportunities. Goal 2, collecting industry data to determine marketing strategies best suited for the company.
Let's ground this in a real-world scenario of M&A deal execution to see how this actually works.
Let's use a cybersecurity M&A deal as our case study.
Imagine you're the banker trying to sell a highly specialized, mid-sized cybersecurity firm that focuses on cloud data encryption.
You've done the valuation, it's solid. But you don't just blast an email to every company on Earth hoping for a buyer.
You go talk to your firm's industry specialist for the technology sector.
This is a senior professional who spends all their time mapping out the complex ecosystem of the tech world.
So for goal 1, obtaining information regarding business opportunities, what is the specialist actually doing for the banker?
The specialist is hunting for the perfect strategic fit. They know the intimate vulnerabilities of the major players in the market.
The specialist might say, look, massive tech conglomerate X just suffered a highly embarrassing data breach in their cloud division last month.
They are currently bleeding enterprise clients because they look weak.
They are desperately hungry for a cybersecurity acquisition right now, not just for the tech, but to loudly signal to the market that they are fixing the problem.
The specialist gives the banker a highly targeted list of the most likely, most motivated buyers. That is the business opportunity.
You aren't just finding a buyer. You are finding a buyer who is already in pain and needs your specific company as the cure.
And then for goal 2, determining the marketing strategy. How does the specialist help with the pitch book?
The specialist tells the banker exactly what those specific targeted buyers actually care about, which allows the banker to tailor the narrative.
The specialist might say, if we pitch massive tech conglomerate X, they do not care about your historical top-line revenue growth.
They have billions in revenue. They don't need yours.
What they care about is integration. They need to know how easily your cloud encryption code integrates with their massive, clunky legacy systems.
And they care about your enterprise customer retention rate.
So the specialist is literally telling the banker which numbers to put on page 1 of the pitch book and which numbers to bury in the appendix.
Yes. They determine the marketing strategy best suited for the company by ensuring the banker highlights the exact operational metrics that will make the targeted buyers bite.
It takes the abstract mathematical valuation and tailors it into a highly weaponized, psychologically targeted sales pitch.
And here's where the entire process gets incredibly intense.
The valuation is done. The massive financial model is built and stress-tested.
The targeted marketing strategy is dialed in perfectly thanks to the industry specialists.
The compliance department is happy.
Now, how does this beautiful theoretical deal actually get priced and sold in the brutal reality of the open market?
How do we stick the landing?
This brings us to the final phase, going to market, and enter the syndicate desk.
Our source mandates obtaining information from the syndicate desk about deals that are in the marketplace, current market demands, security pricing, structure, and covenants.
The way I've always pictured the syndicate desk is like air traffic control at a major airport.
The investment banker spent 6 months designing and building this beautiful, aerodynamic airplane of a deal.
They polished the engines, they mapped the route.
But you cannot just take off whenever you want. You have to call air traffic control.
And the syndicate desk is the one who tells you if there is a massive thunderstorm currently sitting over the runway.
How many other planes are trying to land at this exact second?
And exactly what price the passengers are actually willing to pay for a ticket today.
That air traffic control analogy is remarkably precise. The syndicate desk is the ultimate bridge between the investment bank, which is representing the issuer or the seller,
and the actual institutional investors who are going to buy the securities.
The bankers live in the world of theoretical value.
The syndicate desk lives in the world of real-time market clearing prices.
Let's meticulously break down the puzzle pieces the source says we must get from them, starting with security pricing.
Right, and this might confuse some people because earlier in the process, we did the relative valuation analysis and the DCF model.
We already spent hours calculating the price. Didn't we already find the price?
We found the theoretical intrinsic value, but intrinsic value does not mean market value.
Security pricing, with the syndicate desk, is the act of translating that theoretical valuation into an actual executable launch price that the market will accept today.
The syndicate desk builds what is called the order book.
They go out to the major institutional investors, the mutual funds, the pension funds, and they quietly gauge interest.
You, the banker, might think the company's new Stark offering is fundamentally worth $50 a share based on your flawless comparable peer analysis.
But the syndicate desk comes back and says, we've built the order book. The market is incredibly volatile this week.
Based on the actual bids we are receiving from real investors, the market will only absorb this offering at $48 a share.
If you price it at 50, the deal will fail, and the stock will instantly crash on day one.
The syndicate desk deals in the harsh reality of current market demand.
They are the reality check where the rubber meets the road. If the investors won't pay it, the math doesn't matter.
And what about structure and covenants? The source explicitly demands coordination on this.
This is absolutely critical, especially in debt offerings or leveraged buyouts.
When you are selling corporate bonds or securing loans for a deal, it is never just about the interest rate or the total price.
It is about the rules of the deal. Covenants are the legally binding protections and restrictions placed on the borrowing company by the lenders.
Let's make this concrete. What does a covenant actually look like in practice?
They fall into two categories: affirmative covenants, which are things the company must do, and negative covenants, which are things the company must not do.
An affirmative covenant might dictate, you must maintain a minimum cash balance of $50 million at the end of every quarter.
A negative covenant might dictate, you cannot take on any additional senior debt without our explicit permission.
Or, you cannot pay a dividend to your shareholders until this loan is paid off.
Okay, so how does the syndicate desk influence these rules?
The syndicate desk tells the banker exactly what level of protection the market is currently demanding to feel safe enough to invest.
It is entirely dependent on the macroeconomic weather we discussed earlier.
In a roaring, hot bull market where money is cheap and investors are desperately hungry for yield, the syndicate desk might come to the banker and say, investors are fighting over this debt.
We hold all the leverage. We can structure this as a covenant-lite loan.
Covenant-lite meaning very few restrictions on the borrowing company.
Which the banker's client obviously loves because it gives management total freedom to operate the business without lenders breathing down their neck.
Exactly. But let's look at the inverse.
In a volatile, fearful bear market, maybe right after a major banking crisis or a spike in inflation,
the syndicate desk will have a very different message. They will say, buyers are terrified. They are demanding incredibly strict, suffocating covenants right now to protect their downside risk.
if we don't include a massive list of negative covenants restricting the company's capital expenditures, this deal will simply not clear the market. No one will buy the debt.
The structure of the deal is dictated by real-time market demands, not just historical precedent.
Wow. So the banker, after doing all this incredible foundational work, really has to bend to the will of the syndicate desk and the market if they want the deal to actually happen and get funded.
Which brings us to the final polish.
The text concludes its entire analytical framework with this directive: coordination with internal departments to review data for inclusion in marketing materials and secure approval of those materials.
This final step beautifully and necessarily ties the entire massive framework together. Think of the intense journey we just took to get to this single sentence.
Right, from the very first database search.
Exactly, the initial aggregated database research.
The unvarnished, verified truth extracted from the 1934 Act regulatory filings.
The macroeconomic sector analysis.
The relative valuation models built on peer capital structures and EBITDA multiples.
The precedent transactions mapping out historical control premiums and earnout structures.
The navigation of the Chinese wall and permissible communications to gather forward-looking client assumptions without committing insider trading.
The research department's qualitative sentiment overlay.
The industry specialist's highly targeted buyer strategy.
And finally, the syndicate desk's real-time pricing and strict covenant dictates.
All of it converges.
All of it converges into the final compliance-approved marketing materials.
This is the official pitch book, the confidential information memorandum, the final prospectus that is used to actually execute the deal in the open market.
Every single bullet point in the source material is a rigorous filter.
It is a filter designed to refine raw, chaotic financial data into an actionable, legally compliant, and market-ready transaction.
It is an incredibly intense, almost overwhelming journey.
We started by scraping regulatory databases to find the raw truth.
We built relative valuation models to find the intrinsic value.
We navigated this complex, politically charged maze of permissible communications, so we didn't end up in federal prison.
We leaned on the internal brain trust of research analysts to understand market psychology. We used industry specialists to hunt down the perfect buyers.
And finally, we handed the keys over to the syndicate desk to test our theories against the brutal reality of the order book and clear the market.
If you are listening to this right now, especially if you are gearing up for the Series 79 exam, take a breath.
When you're staring at these bullet points in a textbook, It can seem like a chaotic, arbitrary list of rigid rules.
But hopefully you can see now that it forms a highly logical, deeply interconnected framework.
It is entirely designed to protect the integrity of the market, protect the legal standing of the firm.
And ensure that billion-dollar deals are priced accurately based on verified truth rather than optimistic fiction.
It is a brilliant framework and works incredibly well. It is an engine built entirely on precedent and comparison.
But I think examining the mechanics of this engine leaves us with a fascinating, almost philosophical paradox to consider.
Oh, what is the paradox?
The entire analytical process we just discussed relies heavily on comparable companies and precedent transactions.
The framework fundamentally assumes that the future looks somewhat like the past.
Or at the very least, that a company looks somewhat like its neighbors. You price a company based on what similar companies are doing.
But what happens to valuation and pricing and syndicate demand when a company is truly, genuinely disruptive?
What happens when an investment banker is tasked with valuing a company that has absolutely no historical peers, no comparable capital structures, and no precedent transactions to anchor against?
If a company invents a completely novel technology that reshapes an industry overnight,
How does this rigid, historically focused framework adapt to price the truly unprecedented?
that is a phenomenal question to chew on. How do you confidently price the future when it doesn't look anything like the past?
And how do you convince a syndicate desk to clear a deal when there are no comps to prove your math?
Keep analyzing the world around you. Keep pulling apart the mechanics of how things actually work, and keep asking those hard questions. We'll see you on the next deep dive.